All right. Terrific. Looks like everybody can hear and see. Okay, well, thank you everybody for joining. I'm going to keep checking, so bear with me here because I'm going to keep checking to see if people need to be admitted. For some reason that has been set we have to admit them instead of just a regular click in and log in. So thank you very much for joining today. As everybody knows, I'm Paige Panzarello. I'm the Cash Flow Chick. And we're here today to talk a little bit about, wait, what happened there? Okay, I think we're back on track, yes? Okay. We're here to talk a little bit today about a variety of the three main real estate investing strategies. And the reason that we're going to do that is because, as everybody knows, there are all kinds of shiny objects that are out there in the world of real estate investing. And, you know, people are drawn to a variety of different things. And I'm going to give you a little bit of background on me. Let's see, I'm going to mute everybody. Okay, there we go. I think I just muted everybody. So, you know, again, there's all kinds of shiny objects that are out there. And we need to be able to pick, you know, something that is going to be safe for us, that is going to fulfill our needs. And for me, I, you know, started out my real estate investing career almost 25 years ago. Okay, somebody's, everything should be muted. Perfect, okay. Let's see, let me see. Bear with me, everybody. I'm sorry about that, forgive me. Okay, there we go. All right, so everybody should be able to come in. Everybody should be muted. I think we're good. Okay, so again, a little bit about me, Paige Panzarello, and I've been investing in real estate for over 20 years. I started out as a buy and hold investor by default. I had a family member pass away, and I went to Arizona because we had 38 townhome units that were rentals for us. And, you know, long story short, I ended up turning those into selling them and then taking that money and leveraging it and buying some land and starting a construction company. I had 36 employees. We held all of our licenses and we were building everything under the sun. We built residential, we built commercial, we built smaller projects, bigger projects, and we were rocking and rolling. We were doing really well. And then 2007 happened, and literally it happened right on my head. I was very fortunate in that I wasn't leveraged too much. So meaning I did not owe a lot of money to a lot of people. I had a lot of assets, and I had a lot of equipment, and I was very liquid. The problem was that everybody around me was not liquid. And if they were, they ran the show. Cash is king, as everybody knows. So, you know, at the end of 3 years, I did owe people some money. So at the end of 3 years, I had to fire sale everything. And I did that because I wanted to be able to pay everybody off. I did not want to go the bankruptcy route, you know, which certainly was an option, but I wanted to be able to pay not only my investors, but my vendors. So I sold everything at fire sale prices. And 3 years later, I did manage to pay everybody off. And at the end of the day, I walked away with $0 in my pocket, and I had lost $20 million. Now that shapes you as an investor. It will guide you in your path, you know, that you want to go in. Clearly, I went away from real estate for a couple of years. I had to regroup. But I came back because my passion is definitely real estate investing. I've done fixing and flipping. I've done tax lien sales, tax deed sales. And then I came to the note space. And for me, notes was non-performing notes is what I invest in. And it absolutely angel sang for me. It gives me all different kinds of exit opportunity. It gives me control over my investments. And it generates chunks of cash and monthly cash flow as well. I can make it a short-term play or a long-term play. So that's a little bit about my history. But when I came into notes, again, when I talk to people, I challenge them to determine what your what is. And that's kind of what we're going to be talking about today is we're going to decide, I'm going to give you some of the points and tips on how you decide what's best for you, because all of us as investors are different, every single one of us. And we have different needs. You might have a need for monthly cash flow. You might have a need for chunks of money. And so, if you need monthly cash flow, fix and flip might not be for you because that's a short-term play and it'll generate chunks of cash. And the reverse is true. If you need chunks of cash, don't go into buy and hold. So today is a little bit about determining what your what is, and I'm going to give you some of the differences in the three main categories. Again, three main categories are buy and hold investing, fixing and flipping, and then there is the non-performing note space. And if you're unfamiliar with that, believe me, you'll become familiar by the end of today's session. So, okay, so let's kind of get into it a little bit, everybody. All right, so again, buy and hold, it is a long-term play. Meaning if you're going to go into a buy and hold scenario, you want that monthly cash flow. But you're going to anticipate being in that investment for, 3 years, 5 years, 10 years, 20 years. It is not short term. The flip of that is fixing and flipping. The fixing and flipping is a short-term play. You generally want to be in and out depending upon the size of the rehab that you need to do. You're going to be wanting to be in and out of fixing and flipping, 6 months or less. And then, of course, there's non-performing notes. There's the note space. And in the note space, you can generate both. You can generate a short-term play. You can generate a long-term play. You can, have your investment angle as a 12-month or less, or you can choose to, if you can get a loan to reperform, a borrower to reperform, and we'll talk about that a little bit. But if you can get them to reperform, you can choose to make that as long-term play as you want. And they'll monthly cash flow for you every single month. You'll be getting a mortgage payment. And we'll talk about that a little bit too. Of course, in a fix and flip scenario, you're going to generate a chunk of cash, and that's going to typically be, your quickest time frame. Like I said, 6 months or less. We, in the non-performing note space, can be anywhere from 3 months to 12 months to 20 years. The key is that you choose. You get to choose what your angle is, how long you want to be involved in that asset or in that investment. And there's many different exit strategies that are at your disposal, all right? And the nice part about note investing is we actually get to help people. We can choose to help people stay in their home. And for me and my team, that's a big bonus. That's really important to us, that we get to help people that have life just happen to them, just like life happened to me. We get to help people get back on their feet and have some pride of ownership. Okay. All right. So let's talk about funding a little bit. In the buy and hold scenario, when you're funding, generally you're going to need to come up with a down payment to buy that property, generally speaking. Now, understand there's all different kinds of options for funding in just about every scenario. Everybody's heard about seller financing, et cetera. But understand, I'm talking about things in generalities. So typically, especially if you go in a conventional mortgage, you're going to have to put down a down payment for a buy and hold property. Okay. How much is that investment going to be? How much is that? Is that 5%, 10%, 20%? What is the down payment going to be? If you're in California, 10% on a $300,000 property is $30,000. You know, some people may or may not have that. If you're investing out of state, it might be less depending upon your area. But in either way, generally speaking, you're going to have to come up with a down payment. Funding for a fixing and flip property. You're going to have to come up with a lot of money, because now we're talking about a hard money lender, right? Because the property is broken. Generally, hard money lenders are going to charge you points. So you're talking anywhere between 1 and 3 points, which equates to a percentage. So 1 point is 1% of your loan amount. So 1 to 3 points up front, and then interest rates can vary anywhere between 8 and 15, 18%. It just depends. Now, average is, of course, 12%. Let's see. In terms of coming up with the points, you also need to have holding costs. Now, a lot of new fix and flippers don't factor in holding costs, meaning utilities. You have to pay for your utilities. You have to pay not only your interest, but your insurance. And those costs kind of get left by on the corner, and people forget to include those. So you need to have money in the bank for your holding costs as well during the time that you're fixing and flipping, okay? And then at the end of the day, you might have a gap funder. So meaning you have somebody that comes in that's a second, and they will take a second position behind the loan for the hard money lender, and they're going to provide either your holding costs or your construction costs, or both. Okay, so either way, you generally, unless you have all of the cash up front yourself, you're going to be taking out loans from other people that can be fairly expensive. And you're going to hope that you do well in your rehab and you're able to sell that property. And we're going to talk about that in a little bit as well. In terms of notes, yes, you do need cash. There, generally speaking, is not lending, so to speak, to buy notes, at least from a hard money lender or an institutional lender. Now, that's not to say that you can't go to your family and friends and fund, and take a loan from them. You need to make sure that the numbers work, but you have other options besides, hard money lending. You can go to, again, you can JV partner with somebody. We'll talk about that a little bit as well. But it is a cash and carry asset. The nice part is that when we talk about buying notes, we talk about paying at a very deep discount when we're buying non-performing notes. If you go into a performing situation, you might get a little bit of a discount, but not nearly as much as a non-performing note, which is why I focus on first position. So I'm always the one to get paid first, non-performing notes, okay? Because again, we actually find appreciation. We already build it in, all right? Let's see, Danny said, will there be a replay of this? Danny, we are recording. So I suspect that yes, for those that registered, we will send out a replay. I hope that helps. Okay, let's see. So again, there's a variety of different options in terms of your funding, but there's a lot more flexibility and when you're talking about the note space, in my opinion. All right, pitfalls. Let's talk about some, and if anybody has any questions, please type them in the chat box. I'm here to answer your questions. I want to make sure that you understand, and if you have a burning question, please ask me, all right? Okay, pitfalls, potential pitfalls that we have in relation to all three different strategies. Buy and hold. The pros are that we've got, monthly cash flow, possible tax advantages, possible appreciation depending upon when and how you buy that asset. The flip side of that coin, though, is that even though you've got those advantages, you also have the probability that it's going to take you a couple of years from rent to recoup that original money that you've put down on that buy and hold property, right? You also have toilets and tenants and air conditioning problems and flooding problems. You know, I can tell you horror stories from the 38 units from tenants, you know, what they've done to our properties. I've had, you know, concrete in the toilets and motor oil spewed about all over the carpeting and all over the walls. And now we're talking about a hazardous situation, and we had to have like a version of hazmat come in and clean that up. So there are some potential pitfalls there. And those are all things that you, as the property owner, are going to have to pay for. So, you know, keep that in mind when you're looking at your investment strategies is, do I have enough money in the bank, or can I collect enough in the rent to be able to, you know, put some aside for those kinds of issues? You know, because they do come up. Hopefully if you have buy and hold properties now, you haven't experienced those, and hopefully you never do, but that is a potential pitfall. All right. Property managers. How many of us have had horrible property managers? I can tell you I have, absolutely. You know, we pay them to do a job, but think about this a little bit. If you've got generally a property manager is going to earn, you know, let's use round numbers, 10%. And if you've got a property that's out of state that you're renting for $700 a month, 10% is $70. So unless you have, you know, 5 or 6 or 7 of those that same property manager is handling for you, you have the possibility that that property manager is going to take your $70 a month and not do a whole lot for you. So I could have a whole session about property managers and what to look for, but we don't have time today. But, you know, keep that in mind. A lot of people think, oh, I want that monthly cash flow, but they don't realize, oh, well, our property manager might not do the best that they can do for us. So you have to factor those things in as well. In terms of monthly cash flow. Oh, and property managers, here's another thing about property managers. They have what's called a lease-up fee. And generally it equates to 1 month. And if you sign an agreement with them, the property manager can you agree to pay that lease-up fee. Well, what happens if 18 months later you turn your tenants? Now you're going to pay up another lease-up fee to the equivalent of 1 month. So, and that's hard to recoup once you factor in all the different costs that you have to set aside if you're looking for monthly cash flow and a profit there. So keep that in mind as well. Let's see, what happens if you need to evict a tenant? Depending upon your state, that can take 6 months, it could take 2 months, it could take almost a year. And now you're not cash flowing at all. So what happens, your monthly mortgage payment, if you're leveraged, if you had to use a loan to buy the property for monthly cash flow, you now have outgo, a lot of it. And you have to wait until you can evict that tenant. So again, I'm not trying to scare anybody. Monthly cash flow is great. There are very successful buy and hold investors. I've been one of them. I just think that there's another way. And for me, that other way is notes. So let's talk about a little bit about fixing and flipping, and then I'll give you some pitfalls of notes too, because in every investment strategy, as you know, there's always some sort of risk. There's always some sort of potential loss or pitfall, and you should be aware of them. All right, so fixing and flipping. What are some potential pitfalls? Well, the pros is that if you do it well, and if you've bought well, and you stay on time, you can generate a really big chunk of money, which is great. The cons, I wonder what could go wrong here. I actually have a list, so let me read that to you. First of all, if any of you have ever done a fixing and flipping property, again, they're great. And I love taking ugly homes and making them beautiful. I just don't love all the in-between, okay? But it's a job. It really, if any of you are out there that have done it, type it in, because it's a job. You've got to be on top of your contractors day in, day out. Somebody has to. I used to be a contractor, It's not that we're bad people. It's just that we take on a lot of jobs because we've got to keep all of those balls in the air and keep work for our employees. And sometimes we get distracted. So that's what happens a lot of times with contractors, is that if you're not on top of them all the time, you're going to get distracted. And they're going to get distracted and not pay as much attention. If you're not paying attention to your project, they're going to let it go a little bit on the back burner, as opposed to somebody who is paying attention to their projects. And the squeaky wheel always gets the grease, right? So you have huge interest that you have to pay in monthly payments, generally speaking. There are a lot of good contractors that are out there, but there are also a lot of bad contractors that are out there. In my fixing and flipping days, I can tell you horror stories, awful inspections. You have to deal with an inspector. What if you don't pass your inspections? What if your contractor steals your supplies? I've actually had that happen to me. They get paid through the draw, through the hard money lender, because we submit receipts and they send their inspector out. He signs off on it. We get the check, and then the contractor takes the supplies and returns them, takes them off his charge. I've had that happen to me. It's a potential pitfall. So you need to be aware of that. Budget overruns, time overruns. When you're in a fix and flip property, you estimate the amount of time that you're going to be in that property and turn it. And if you hit your mark, awesome. But if you miss your mark by 2 or 3 or 4 months, what's going to happen? You still have your profit margin is going to shrink every single time. Every delay that happens, your profit margin is going to shrink. And if it happens too much, then you have the potential for loss. So really, build in extra time. If you're a fix and flipper or want to fix and flip, please build in extra time, because it very rarely does a project land on time or early. Rarely. It does happen, but it's rare. Okay. What happens in a fix and flip, because when you go into a fix and flip, you're actually speculating. You figure out what your after repair value is, what the comps are and what you figure you're going to be able to sell it for. But you're speculating. You're educated guessing at what point you're going to be able to sell and what time you're going to be able to sell that fixed property. What happens if you run over by 4 months? This does happen. What happens, do markets change in 5 to 6 months? Yes, all the time. So if you now have a budget overrun and a time overrun, and now the market has shifted, what is happening to your profit? It's dwindling, going down, down, down. So just be really careful if this is your chosen, field or method of investment. And I know some very, very successful fix and flippers. I choose to take a smarter path I don't want to work that hard. In my opinion, it's a smarter path. For others, maybe not so much, but just be aware, okay? Home inspectors. So you've finally fixed your property and now you have a buyer, and now there's a home inspector that comes in. Do home inspectors create problems for closing? All the time, all the time. Realtors, escrow companies, all of these people are involved that can tank your profit. And all of these people are outside of your control. Think about that. Every single person that is involved in your profit is out of your control. For me, I'm not comfortable with that. I'm just not. So, again, I feel there's a smarter way to invest dollars and a way to mitigate all of this risk. And we're going to talk about that in a moment. In the meantime, does anybody have any questions? It doesn't look like it. It looks like we're doing okay. All right. So the exit of a fix and flip. Another pitfall, what you need to sell it as fast as possible. The possibility, if you don't meet your timeline, and if you've got a short-term hard money loan, sometimes you can re-roll it for more points. But there's a time frame. It's very short term. Hard money lenders are short term. Very rarely do they go long term. They want to get their money and they want to get out. And believe me when I tell you, they have no reservation about foreclosing on you. So, you know, you do have some options, but that is a very real possibility. In non-performing notes, the pros, you're the bank. You actually become somebody's bank. And if you think about that, you are the one that is calling all the shots. You have control over your investment, okay? You can generate monthly cash flow, and you can do it in a variety of different ways, not just one avenue, but several avenues. When you invest in non-performing notes, there's 23 different exit strategies that you have at your avail. 23. Not so with the others. So as things shift and as things change, you have flexibility and you can move with those shifts and with those changes and maintain control, okay? That's a huge point, at least for me as an investor. You can create chunks of cash because you can, if you decide to take a short sale from a borrower, there's a couple different exit strategies, and we're not going to dwell too much on exit strategies, but our four main are to get the borrower to reperform, which means that they start paying again. Okay, you generate a chunk of cash because you require a small deposit from them, a reinstatement fee, that's what it's called. So now you've generated a small chunk of cash, and then you require them to pay their monthly mortgage payment. And when something breaks, they don't call you because you're the bank, okay? So you generate a chunk of cash, you generate streams of cash. Short sale, everybody knows what a short sale is. So you're owed X amount of dollars and you agree to take less than what you're owed. That's a chunk of cash, okay? A deed in lieu of foreclosure, that means the borrower no longer wishes to retain the home and they sign it over to you, okay, as the bank. Now, as the bank, you now take title to the property and you can do a variety of different things with it. You could sell it to a fix and flipper and carry their paper and become a hard money lender, okay? You can put a renter in it if you really, really want to. If the market totally tanks and you're at a break even and you want to make some money and wait for it to go up a little bit, you can put a tenant in there, okay? There's so many different exit strategies available to you that it's just, it gives you control and it mitigates your risk, okay? Foreclosure, let's see. Foreclosure, of course, is, everybody knows what foreclosure is. So we'll generate a chunk of cash by selling it to a third party at foreclosure auction, or we take the property back. If it doesn't sell to a third party at foreclosure auction, then the property comes back to us as the bank as paid in full. Now we can do a variety of things with that property. We just talked about that, all right? So pitfalls of note investing. The pitfalls in note investing is a lack of education. And I mean that. It's really a lack of education. The pitfalls are if you don't know what questions to ask, if you don't know what due diligence steps to take, then you have the potential for loss. I say that there's no such thing as buying notes badly. There's no such thing as buying as a bad note, but there is such a thing as buying a note badly. So again, the pitfall of note investing is if you're uneducated and you just jump in full bore and don't know the questions to ask, then you're not going to be able to buy that note well, and you're not going to be able to mitigate your risk. However, if you know the steps to take, if you know the due diligence to perform, if you know the questions to ask, then you can all but mitigate almost all of that risk. And again, the beauty part is that we have flexibility because we have control. If you buy a note well, you're building in appreciation. You find it, it's already there because you buy it at such a discount. And with that, it gives you flexibility and it gives you control to mitigate that risk, okay? So Different exit strategies in terms of notes. You know, what's a potential pitfall? Okay, well, you could sell it at a break-even point. If the market crashes, let's say the market crashed 50%. Now, historically, that has never happened in a 6-month period of time, okay? But let's say it does. Well, if you've bought that note at 50 or 55% on the dollar, and you've built in an exit strat, you know, that cushion, if the market crashes 50%, are you still pretty okay? Yeah. Couldn't you wait it out? Because yes, because again, you've paid cash for this. You don't have a loan that you have to worry about. You've paid cash. So there's strength there. There's control there. That's how you control your investment and you mitigate your risk. Could you sell it to an end user? Absolutely. So you could sell it to, you could sell it to a retail buyer. You could fix and flip it yourself if you want to, and then sell it to a retail buyer. You can carry their paper, or you can, and so now you've generated a down payment, an earnest money deposit, and you've generated monthly cash flow. Okay. Let's see. You can sell it to a fix and flipper, carry their paper, generate the points and the monthly cash flow. That's on the short term. But again, you're generating chunks of cash and streams of cash. You're not focused only on one. You can do both, okay? You can wait for it to appreciate. You can rehab it yourself. There's so many different exit strategies and so many different options if you know what questions to ask, okay? Let's see if there's any questions. I'm not seeing any questions. Everybody good so far, following along? Okay. All right. Tragedy. Weather. We just saw horrible things happen, you know, in Puerto Rico, in Houston. We have hurricanes. So tragedy. What happens in the 3 different buying, you know, investment strategies? So if there's weather, if there's fire, if there's earthquake, tornado, any of those things, in a buy and hold situation, of course, you're going to have insurance, right? Okay, Danny, bear with me one moment. Let's see. Danny asked, is buying performing notes and accumulating them for cash flow a strategy? Absolutely, Danny. There are plenty of people out there that buy nothing but performing notes. As I explained earlier, and it's a great strategy for monthly cash flow because again, you're the bank, you're not the landlord. So if something breaks on the home, then the borrower is going to call a repairman, not call you or your property manager, and that repair does not come out of your pocket. Again, I like to mitigate risk, so I buy non-performing because I get a much bigger discount. And my goal and my team's goal is to help that borrower to get them to reperform. So now we've got a huge equity cushion. We can sell it to another note investor, and we're able to help that borrower stay in their home and generate quite a nice profit. You know, because we generate a chunk of cash up front and monthly cash flow through what's called seasoning the note, which means that the borrower pays for a certain period of time, and then we have the option to either sell it to another note investor or keep it for monthly cash flow for us. So that's my preferred method, but absolutely buying performing notes is absolutely a monthly cash flow strategy for a lot of people, and it's a lot less headache as far as I'm concerned. Okay, so back to insurance. You're welcome. Back to insurance. So in the buy and hold situation with regard to insurance, again, if you have taken the property, unless you paid 100% cash for the property, which some people do, but most people will take a loan out, who's the lost payee? The bank, right? So the bank needs to get paid. Now, sometimes there's replacement costs, you know, that insurance companies will pay, but you still have to pay that monthly mortgage payment. And if your home is damaged, you're not taking in any money from a tenant, right? So there's a lot of outgo, and there's nothing that comes into your pocket, nothing at all. Okay, you at best are going to be able to rebuild that property, but you're still now going to have to recoup all the costs of the monthly mortgage payments that you've made while it was being repaired or rebuilt. Okay. Or you could walk away at a loss. Clearly, you could take the check and walk away. You know, the bank though is going to want payment, so they're either going to foreclose, or sometimes they will require that they're paid off first. So it just depends on your mortgage and the statements, you know, the way that the mortgage is written. So be aware of that. But generally, banks like to get paid. I know I like to get paid. So, you know, they're not going to just let you walk away. They're going to want the rest of their money. You know, you can rebuild it and you can find a new tenant. So that's another thing, you know, that is a possibility in terms of the insurance. Thank God for insurance. But, you know, in a buy and hold situation, if you're leveraged, meaning if you have a loan, you're kind of in a precarious position. Fixing and flipping, insurance will absolutely pay that hard money lender off first. If you've got a second, it will absolutely pay that second off second. Okay. There's not going to be anything left for you. There just isn't. Because very likely, you know, and there have been fires that have happened in fixing and flipping. You know, contractors make mistakes. They just do. And I've seen it, you know, fires do happen. And that insurance is going to pay the hard money lender first, the second, and might, you know, rebuild some of the project, but not all of the project. So there's no money in it for you. In terms of fixing and flipping and the insurance and the hard money lenders, understand you're already starting. You start that project in the hole, and you're banking on, you're hoping and praying and speculating that you're going to be able to finish that project on time every time, and that you're not going to have delays, and that you're going to be able to sell it for what you want to sell it for, and you're going to be able to put money in your pocket. But you start out in the hole. Okay. Same thing with a buy and hold. You start out in the hole. Not so with non-performing notes, because we buy based on current market value at a discount. So we build in equity. So if the current market value as it sits right here and now is $80,000, we're going to use really round numbers. Pricing has gone up a little bit, but let's use really round numbers because we want to keep it simple. If the current market value of the home is $80,000, now that's our collateral. Remember, that's our security. In the home, we will pay about $40,000 to $45,000 ish. Now, again, I'm using lower numbers for easy math. Pricing is a little bit higher now, but easy math. We'll pay, let's call it $40,000 for that note, and our security is the home. We've already built in, if we paid 40 and it's currently, as it sits, worth 80, we've built in an equity cushion. We're not in the hole. We're not in the hole there. We have, that could be sold immediately. You know, if the borrower has to sell the house, or we have to sell the note, we already have equity. Okay, that starts us off in the positive, not in the negative. Okay. Let's see. Non-performing, we were at insurance. Okay, so insurance. Now, as non-performing note holders, excuse me one moment. As non-performing note holders, being the bank, most people say, why on earth would you step into a situation where somebody's not paying on purpose? You know, how is that possible? And how, you know, if they're not paying, most people have their taxes and insurance impounded in their mortgage, meaning they add on top of their mortgage payment the taxes and insurance on a monthly basis. Now, the insurance, we as the bank have the legal right to insure and secure our investment, which means we can do what's called force placing the insurance. So if the borrower is not performing and we don't know if insurance is in place, we contact our insurance carrier and we force the insurance to be placed on that securing collateral, meaning the house, okay? That gives us a whole lot of control. Now, if weather happens, if tornadoes happen, if anything happens to that property, as our forced place insurance or as the loss payee, we collect a check, okay? We collect a check. We're the first to get paid. So that makes us happy. We don't have to deal with a broken house. We don't have to deal with any of that. Now, if the borrower decides, if weather happens, the borrower decides to walk away and we end up taking that house or that now property, maybe it's just land. If we take it as a deed in lieu or through foreclosure because we want to exit out of our loan that we loaned, that the borrower owes us money, we get that insurance check, we cash it, we go to the bank, we cash it. And if we take the property back, the land back as REO, can we sell the property for a profit too? You bet. So could we rebuild if we really, really wanted to? Could we rebuild and then have somebody else come in and sell it to somebody else? You bet. Again, there's lots of flexibility in the non-performing note space, okay? Insurance is our friend. We love our insurance because we get paid first, being the bank, okay? All right, let's go into market shifting and crashing, because as everybody knows, we're really kind of at the peak right now. We're at the height of the market. It's kind of slowing down and leveling off. Some areas not so much, but everybody knows that there's going to be a correction coming, okay? So let's say that the market crashes. What happens? In a buy and hold situation, again, you still have that monthly mortgage payment that you've got to make to the bank if you've taken out a mortgage, okay? You're now underwater, very likely, if the market is crashing, okay? You're now gonna have a whole lot of competition, because if the market is crashing and people are underwater in their mortgages, they move out, they get foreclosed on. There's now a lot of competition for rentals, which can be a good thing or a bad thing. Everybody needs to live in a place. Of course, most people tend to like to live in houses, but you're very likely going to have to drop your rents to put somebody in there, okay? If you're in an emergent situation and you need to sell that property and the market has crashed and you're underwater, you're now talking about a short sale and you get no money. So, there's all kinds of pitfalls with regard to that. And again, if the market crashes, everybody's going to be looking for rentals, and now you're talking about dropping your rent, and that might not cover your monthly nut that you need to cover. So keep that in mind. If the market crashes in a fix and flip property, oh my gosh, now you're really in trouble because that hard money lender, and probably that second that you have, is definitely going to want to get paid. And so they're going to foreclose. Okay. There's generally no short sailing. Hard money lenders are going to take your property. They generally will not short sale. Okay. And I say that as a generality. You might find one, very unlikely. All right. And you're going to have to sell, you're going to take a loss. Hopefully you don't have JV partners that have put money in with you that are now also going to take a loss. Because that market has crashed. In terms of non-performing notes, let's say that the market crashes. Okay, we've built in a 40 to 50% cushion of equity. So if the market drops 50%, and by the way, we pay cash, so we're not leveraged. So if the market drops 50%, are we still okay? Of course. Do we have a variety of different options that we can do to wait it out and wait until it appreciates again? Absolutely. Could we put a tenant in there for 2 years and now start to monthly cash flow? Sure. Better yet, could we put a new borrower in there and sell it and carry the paper for the new borrower? Absolutely. That happens all the time. So again, if you buy well and you mitigate your risk by doing your due diligence well and educating yourself on what due diligence to do, you're going to be in a great position even if the market crashes. Okay. And again, you know, everybody likes to live in a house. So as the bank, you've got a variety of different exit strategies. You've got all kinds of flexibility as long as you educate yourself on how to buy well. All right. Um, Again, there's so many different things that you can do. And for me as an investor, I like to have that kind of flexibility. I like to have that kind of control. As the bank, we very rarely rely on others for our profitable outcome. We've already looked at what kind of profit we're going to make, and we build it in when we buy it. We don't start our investing in the hole. We actually start as in the positive, and it just can go from there. Okay. Let's see, questions. Does anybody have any questions? I'm going to wait for a few minutes just to see if anybody has anything. Take a sip of my water. I must be doing things well. Nobody's got any questions yet. Okay. So I kind of want to wrap it. How do I find the note? Perfect. That's a great question. Okay. Like anything, there are two things that most investors look for, deals and money, right? And we'll get to due diligence in a moment. So finding the notes, that is a great question. There are a variety of different ways that you can find notes. They're more popular nowadays. More people know about it, but it's still a very niche, very boutique space. So you're going to go online. You're going to talk to people on BiggerPockets. Do a search for note investors on BiggerPockets. You're going to listen to podcasts and connect with note investors on BiggerPockets. There are local RIA groups that are now starting up with for note investors. And so, you know, and you talk to everybody. There are a couple of places online that you can buy notes. I do not suggest doing that until you have educated yourself to the point that you know what questions to ask, but they are available online. You can go to conferences. I just got back from the IMN conference that was in Dana Point. Fantastic. There are note investors that are there that sell notes. There are brokers that go to these conferences. There are asset managers from hedge funds that you can meet and connect with. There's another conference that's every year at the end of April. It's called Paper Source, the Paper Source Symposium. That is a great symposium, especially for those that are beginning in notes. But there's asset managers there and other note investors. There's the Note Investor Summit that happens every year as well. So there's so many different places that you can go to buy notes. You know, and then of course, through myself and my team, you know, I'm going to talk a little bit in a moment about how you educate yourself. But, you know, we give you our resources as well, and I'll get there in just a moment. But I want to get to let's see, to Mackenzie's question. What do you mean when you say doing your due diligence well? Okay, so due diligence is key to making sure that you buy your note well. Now, when you do that, you're going to mitigate your risk. Okay, knowledge is power. And when you have power, you have control. All right, so doing your due diligence well means knowing the steps to take, knowing that you've got to call and verify any delinquent taxes, knowing that you have to call about code enforcement, knowing how to do a deal analysis, knowing, you know, having your set criteria about county population, crime rates, all those fun things. Those are all steps that you take to do your due diligence well and mitigate your risk. And it's literally just a checklist, and you go down the checklist and you check each box, you're going to be able to have a very secure footing and really mitigate that risk and know exactly how much you should pay for that note, and build in that appreciation. And when you do that, again, it gives you flexibility, it gives you control, and it mitigates your risk and secures your invested dollars. Okay, I hope that makes sense, Mackenzie. Emily says, what a newbie note investor need to watch out for? Lots of all those things, all those pitfalls that I just mentioned, Emily, are things that you need to watch out for. And it can be very daunting if you don't know, again, the questions to ask, which is why I strongly urge people, this space is fantastic. There is a lot of front-ended due diligence that is involved. The nice part about it, though, in my opinion, is working smarter, not harder. We do a lot of front-end due diligence. When we buy the note, then we pass it off to our team. We have a lot of team members, and we'll explain that. We don't have a whole lot of time to explain that now, but then you manage those managers, and they do all the day-to-day stuff, okay? So very heavy in the front-ended part of it and doing your due diligence. Even if you're new, as long as you know those pitfalls and what you should do in terms of your due diligence steps, you're going to be okay. You should be okay. All right. Where do you get funding? Okay. So funding, again, is everybody that you know. You tell them that you're an investor. I strongly urge new note investors to joint venture with somebody at least the first 1 or 2 times, okay? Just so you can get your feet wet and get your understanding. There are a variety of different places, but people that you know that have IRAs, you can joint venture with them. IRAs can, especially self-directed IRAs, can invest in notes. I literally have had, I went to my dental appointment, and my dentist has become an investor. So I talk to everybody. I talk to everybody I know about what I'm doing. And, you know, the nice part is that while there are some very successful investors that invest in the stock market, in my opinion, the stock market can be largely out of your control. In this space, it's largely in your control. So, you know, come up with your elevator pitch, come up with your, you know, why you're doing this, and be excited about it, but educate yourself first, because it is a huge responsibility to joint venture with other people and have funds together. But if you use other people's money, which does happen in this space, because eventually at some point your money caps out, you only have so much that you can use to invest in. You know, it's a huge responsibility. So really educate yourself. Okay. That's really, really important. Another thing is that, I don't know if any of you know this, but most people at the age of 45 do not have more than even $25,000 in retirement funds. Most 45-year-olds don't even have $25,000 saved up in retirement funds. And that's pretty scary. So, you know, they might have some savings, or they have it in the stock market, in an IRA. So this is a space where you can create generational wealth if you do this well. But again, education is the key, okay? What Joseph says, what states do you focus on? We focus across the country, and for new and note investors, you might not want to do this. You might want to pick just a few states to start and then go from there. But we focus across the country. Our model is an investment strategy that is 12 months or less. And so we choose states, we choose not to invest in states that have a longer time frame in terms of their foreclosure. Now, there's states and non-judicial foreclosure states. The difference is that in a judicial foreclosure state, the time frame is a little bit longer, and you have to go in front of the court to get court approval to foreclose. And then once you do foreclose, you need to get court approval after the foreclosure that it was conducted properly. Okay, so that process takes a little bit longer. And so if that process is delayed, like New York, for instance, we don't invest in New York. And the reason that we don't invest in New York is because their foreclosure process takes a minimum of 36 to 48 months. That doesn't fit our timetable. So we don't invest there. Okay. Again, these are all things that you're going to be able, and I'm going to talk about it in just a moment, but these are all things that you're going to be able to set up for your criteria and what's good for you as an investor. And then where to focus your energies and what states to focus your note investing career. But you'll learn how to do that as well. And then Linda says, how do you put together a self-directed IRA? Linda, let's see. There's all kinds of different ways. And if you, I am not a tax professional, but I am more than happy to give you some referrals. If you send me an email to info@cashflowchick.com, I'm more than happy to give you some referrals to some great IRA companies that we've worked with in the past and continue to work with, and they can get you set up and how to do that. All right. Let's see. Yeah, Joseph says, too many questions. I'll have to fly to Costa Mesa next month and ask you myself. Yes, absolutely. And Linda, you're welcome. Yes. Okay. So let's talk a little bit about your education. This is something I want you to know that I do conduct with my team and my business partner. We do conduct a workshop. It's a 3-day workshop. It's hands-on. Okay. You are going to learn how to find notes, how to fund notes, what to do with the notes once you buy them. You're going to know every single due diligence step you need to take. Well, not every. I shouldn't use that all encompassing, but we will give you a long form of the due diligence steps that you have to take, the questions you need to ask. We actually have you perform some due diligence at the workshop. It's buildingwealthwithnotes.com is the website to go to for more information. We also limit the space. There are only 50 seats available. There will not be 51. And the reason that we do that is we want to make sure that we can answer all of your questions, that you have hands-on, one-on-one with myself and my team, that you get all of the information that you need. We actually give you some of our tools that we use. We also give you resources, our actual team members. So we give you our connections. We will give you some of our hedge fund managers where you can buy a note, okay? We bring in guest speakers and we feed you lunch. So 3 days, very intensive, hands-on, 50 seats, not 51. It's going to be July 20 to 22. That's going to be in Orange County. So this year, we only do this 3 times a year. And the reason that we do it is because we want to educate and give back. That's part of our give back. We want to help people create a better future for themselves in a smarter way. And be able to have flexibility in their investment schedules. We are not educators per se. We're not a guru that says, run to the back of the room and whip out your credit card. You're not going to get that at the Building Wealth with Notes workshop. That is not what we do. We are full-time note investors, but part of our give back is to help you to create a better future for yourself as well. So again, buildingwealthwithnotes.com. And actually for being on today's meeting, what we're going to do is we're going to give you a little bit of a freebie here. So if you want to bring a second person for free, send me an email to info@cashflowchick.com after you have registered with for the Building Wealth with Notes workshop, July 20 through 22. And I will let your second person come for free. Okay. Generally that is $197 for the second person. But we're giving you the discount to let them come for free today. All right. So buildingwealthwithnotes.com. We hope to see you there in July, and it's just going to open up a whole new world for you and help you to create the future that you want for yourself and your family. Oh, great. Thank you so much, Mackenzie, for putting that out for everybody. That's awesome. Anybody else have any questions? We're about to sign off. Doesn't look like it. All right. Well, if you do, please email me again, info@cashflowchick.com. And I hope to see you in July. Thanks, everybody. Have a wonderful day. Bye.